Most real estate investors are using the wrong mortgage. It's costing them deals, cash flow, and scalability. The right loan can mean the difference between a property that bleeds money and one that builds long-term wealth. Keep picking the wrong mortgage type and you'll either run out of lending capacity or lose the leverage you need to grow your portfolio. I'm Andrew Russell, owner and founder of RCG Mortgage, and I specialize in helping investors amass riches through real estate by getting the right loan product with the best deal. One of my clients, Jason, actually came to us when he was struggling in buying rental properties. He actually already amassed several. And because of that, lenders, they actually put a cap on it at times. They weren't willing to extend a lending capacity to him to purchase more properties. Super frustrated because he had first dibs on a lot of undermarket properties where he would buy them, kind of renovate them a little bit, and then retain them and rent them. He wanted to grow riches via real estate. So we actually did a quick pivot. We pivoted to a DSCR mortgage, which is a non-QM loan. DSCR is debt service coverage ratio mortgage, where it's an investment purchase. And because of his experience, we're able to get an unlimited portfolio for him by putting at least 20% down, and it goes off the market rent. We didn't need his tax returns, didn't ask any questions on what he does for a living. The fact of the matter is, he was a seasoned investor, and every property he found, as long as he had 20% down, and there were no health and safety issues with the purchase, as long as, to keep it simple, the market rent covered the mortgage, which it did every single time, he was able to qualify. So every 2 or 3 months, we got a new call from Jason, and he said, hey, bros, I'm interested in buying another investment property. So we did the specs for him, whether it's a 1 family, a 2 to 4 unit, a condo, and we saw with 20% down, what did the mortgage payment look like? And based off that, what did the realtor, or with his diligence, what did they see kind of sort of was the market rent, and what would that look like? And would it at least cover the mortgage, which it did? And we held his hand, and every few months, it was the same thing. Hey, found a property. These are the numbers. Oh, it works. Great. Go into contract. And it was a 2 to 3 to 4 week close every single time. But I hear you guys now, Andrew, it's really not that simple. There's no way you can amass real estate riches in this country with just 20% down and just market rent. So again, he who has the money makes the rules. He or she, of course, I should preface that with. So with these loan programs, they've realized with these seasoned investors, and there's some guidelines, right? They have to be at least not a first-time investor is typically what they're looking for. Credit score requirements, they usually want a 680, 700 or more. They want to see a good credit profile. Again, reserves. What's reserves? They want to see money in the bank. They want to make sure, if they're just basing this on market rent, if, say, God forbid, the tenant's not paying the rent, which then obviously goes to the mortgage, that you have enough money in the bank for a rainy day, which is a reserve is your mortgage payment. So say your mortgage payment is $5,000. If you have $5,000 left to your name, that's 1 month reserve. If you have $30,000 to your name at closing, that's 6 months reserves. $60,000 is a year. So sometimes they want to see 3, 6, 12 months of reserves. So it's a little bit harder than potentially a conventional mortgage. But without a doubt, it's the best way to amass riches. The interest rate gap, typically say, hey, Andrew, the rate must be so much higher. If the market rate's 6%, you're probably at 8, 9, 10%. It's actually not the case. Rates on these are pretty similar to a conventional mortgage. Sometimes you have to be on the lookout. There's a prepayment penalty, which means if you pay off this mortgage or pay a huge chunk after a year, 2, 3, 5 years, is a small penalty, but typically these investors, they're holding on to these mortgage and they're not paying them off all that fast. Closing costs, Andrew, they're probably so much more expensive, so much more out of pocket. It's not the case. Like I said, ad nauseum, if you're an investor, this is the exact type of mortgage you should be looking into almost every single time. Let's talk about the most popular non-QM investment mortgage product types and the ones that have taken the world by storm. So, of course, the most popular, without a doubt, undisputed champ of the world, the DSCR mortgage, debt service coverage ratio. And what it is it's hit the market, especially on the residential side of the last several years, and it goes off the market rent. So typically, you can't be a first-time buyer because they think, hey, you're going to buy this and move in. They're for investment. If you move in, that's occupancy fraud. It's a big no-no. So they want to see typically that you own a property already or that you have a rental already. So the purchase is typically structured a minimum of 20% down. Now, good news, title can be an LLC or corporation, so it covers you from a legal perspective. And it looks at the market rent versus the mortgage. So typically, they want it at a 1-to-1 ratio, which means if you're buying a $500,000 house and you're putting down 20%, your mortgage would be $400,000. Now, say the mortgage is rate somewhere in the sevens, a $2,800 mortgage payment. If you add taxes and insurance, say $1,000 for taxes, $200 for insurance, you're at $4,000 a month for a mortgage payment. Very rough, not specific, but just to give you a general idea. That $4,000 mortgage payment, they want to see the market rent for that property, whether it's a 1 unit, a condo, condo might have some other monthly fees, of course, added in, a 2, a 3, or a 4 unit. If you add all the rent together by the legal usage, it has to equal or exceed the mortgage payment, which is $4,000. Now, there's a lot of loan options when it comes to this type of mortgage product. There's a 30-year fixed, 20-year, 15-year, adjustables. But I would say, especially in my experiences, the most common is a 30-year fixed rate product. Why? Because seasoned investors typically, if they're not getting 30-year fixed rate, they might be doing private or hard money. They're taking 1-year interest-only loans, so they welcome the opportunity at a low interest rate on a 30-year fixed. Sometimes on these programs, they have a prepayment penalty. What does that mean? It means that if you have a 0-year prepayment penalty, then there is none, obviously. If you have a 1, 2, 3, or 5-year prepayment penalty, it means if you pay off the principal either in whole or a large portion of it before or on top of that monthly payment that you have, call it, in our case, it was $4,000 a month. There's actually a penalty. No, nothing bad happens to you. No one shows up at your door and scares you and your family while you're having dinner. It's actually just additional fees you have to pay. And there's all different types. And, it's something you inquire, obviously, with your loan officer. But typically, they do have prepayment penalties. The lender servicers, they want to make sure that you hold on to these loans for at least 5 years or more. Why? Because they make their interest on you, it's the truth, in the first handful of years. So that's the most popular, the debt service coverage ratio. Now, sometimes things happen within that mortgage type, meaning you might have the rent and it doesn't cover the full mortgage. Say the payment's $4,000 and the rent's $3,000. So it's only 75% of the payment. There are lenders that allow the debt service coverage ratio to go down as low as, say, 0.75. Now, what's the catch? Sometimes the rate's just a little bit higher. Say there's a half adjustment higher for the rate. It's considered more risk, of course. So the rent has to come from somewhere. It's assumed to come from you, of course, as the landlord or the owner. So with that said, if the going market rate was 7.25% on a 30-year fix, for argument's sake, for a DSCR straight up mortgage where there's a 1-to-1 ratio, the rent covers the mortgage. If the rent doesn't cover, and say in the case of a $4,000 mortgage, the rent is $3,000 and it was at that 0.75% ratio or 75% of the actual mortgage payment, what's the catch? Maybe the rate's 7.75%. Maybe they want you to put an extra 5% down, but it's nothing all that crazy. But that is allowed. There are lenders who allow the rent doesn't have to fully cover the mortgage, which as the market keeps improving and as these loans keep performing, which means in the secondary market that people are actually paying their mortgage on time consistently, they will get a little bit more aggressive. What does more aggressive means? They're going to give you a qualification for a property even if the market rate doesn't cover. Now, outside of that, a second type of investment non-QM purchase or program is you do a no ratio or a no income check or a straight off of a down payment, assets, and credit. Now, the positives is we don't care what the market rent is. We're not even going to ask, which is cool. It sounds so simple, right? So some of the negatives or some of the cons are where the interest rate's a little bit higher. So say again, in the case of 7.25 being the rate for a DSCR where the rent covers, 7.75 being the rate if the rent just covers but not fully. Maybe in the case of the no income or the no ratio programs where it's on pretty much nothing, the rate could be in the high 7s, could be in the 8s, could be in the 9s, maybe depending, could be in the 10s. But of course, you get what you pay for. So if you're not willing to show anything and if the rent doesn't cover, there's always another option. In this case, it's just simply the interest rate's a little bit higher. Now, you're not stuck in these programs. It might be a small prepayment penalty again, but you could always refinance when the rent improves or there's other different factors. So outside of the DSCR mortgage, where you either go off the rent or the rent's kind of close to the payment, there's the no income or the no ratio programs, which are just purely on a higher down payment. That's potentially another con. Maybe the down payment's 30, 35, 40, 45, 50% instead of 20%. Maybe you don't want to put that much money down, but you'll have no choice. Another option is there's asset-based lending for these, which is kind of cool. Now, take, for instance, if you have a $500,000 sale price. Say you're putting down 20%. That's a $400,000 loan. If you have, as an example, say 125% of the mortgage left in the bank after you close. So on the asset-based program, say the sale price is $500,000, you're putting 20% down, and the loan amount's $400,000. what it looks at, which is super cool. No rent, no income docs. They're going to see how much you have left over in the bank. Say you have $1 million. They're going to want to see all the mortgage balances you have. So obviously the new mortgage balance is $400,000. Maybe you have some other mortgages that amass to $200,000. So 400 plus 200 is 600. You have $600,000 if we close on this purchase of outstanding mortgage debt. Now, if you have 125% of that mortgage balance, so 125% is like what? 750,000, 600,000 times 1.25. If you have that left in the bank, you qualify. It's that simple. It's called asset-based lending. So in the case of what we just went over, $500,000 sale price, 20% down is $400,000. That $400,000 plus all of the mortgage debt, which is another $200,000, that's $600,000. If you have 1.25, there's a lot of numbers here, folks, 1.25 of that, which is another $750,000 in the bank left over, you qualify. Now, that's one way of figuring out asset-based lending. There's a couple other ways. You don't need a 1.25 of it, 125%. You might be a little bit less, but then it looks at what other actual normal debt do you have. Do you have a really expensive Lambo? Do you have a yacht? You have credit cards, student loans. But if you don't have a lot of other discretionary debt, there's an opportunity that you don't need that 125%, maybe a little bit less, or there's an opportunity to take all your outstanding mortgage debt and you only need 100% of that left over, or a 1-to-1 ratio, but they require maybe some reserves on some of your properties. Again, reserves are the monthly mortgage payment. How many amounts of those? In other words, if the mortgage payment is $5,000, if you have $5,000 left over, that's 1 month. 6 months is $30,000. 12 months is $60,000. They'll add that on top of the 100% requirement for the third option for an asset-based lending program. So it gets a little bit convoluted, but typically it's just best to know that when you buy a property on the investment side, you could actually not even have to check the market rent. You just qualify organically with a great interest rate on these, as long as on the asset-based program, you have a lot of money left over, and we kind of gave you some of the ratios, and it's easy to situate, based on some of these examples. Now, of course, good food for thought. There is the new rise of the Airbnb, VRBO, whatever, all that cool stuff. It's kind of a little edgy. Sometimes it's accepted, depending on some of the legislation and, some of the areas and what's legally accepted or not. It's kind of like a gray area thing. So just be careful if you're assuming qualification on a DSCR mortgage based on Airbnb income or things that are similar. It's always easiest if you just go off of the market rent, and we went over how the market rent has to cover or slightly cover, or there's other options as well. But the Airbnb side has been a little bit edgy. It's doable, but it's a little bit more difficult, and pretty much day to day you never know if it's going to be around. There's also portfolio options. Portfolio are, say you're going to buy 4 one-unit properties. Now, 4 different ones. There's a very small boutique group of lenders that'll finance one loan blanketed on all 4. So they'll look at the amount of units. Maybe they have a minimum. You have to buy in one pop 10 units at once. So in other words, if you buy 4 3-family properties, that's 12 units at once, they're willing to give you, a great deal leverage over all the properties. There's a lot more that goes into it. Rates haven't been the best on some of those as well. So it's a lot easier in theory. You go to one mortgage company that covers 4 properties and it's one application, but that's few and far between. We haven't seen that all that much, but that is another option for non-QM investment purchases. So a quick way to figure out which of these makes sense for you, just remember, are you buying a rental property, putting at least 20% down on the market rents there and covers? Do a DSCR mortgage. Are you buying a rental property and the rent isn't there, it's a fixer-upper, nobody's renting at all? Do one of the no income, no ratio programs. Down payment's probably a little bit higher. Do you have tons of cash-ish left in the bank after you close? You don't have to worry about rent and all that other stuff. Do the asset-based lending. These are the 3 most typical programs that people are utilizing, and it's just a quick thing for you guys to realize which one makes sense. You know what? Check out the description, guys. There's going to be a link. Our investor cheat sheet options for mortgage. Make sure you go in the description, click the link, get your investor cheat sheet. It shows all the different mortgage types we've actually just went over. We created for you guys. Make sure you download it and use it for the best kind of roadmap on which of these mortgage products in the non-QM space on the investment side will make sense for you. If you found this helpful, the next video for you to watch is the Mortgage Playbook for Real Estate Investors. Click here to check out the video. It's going to be behind my eyes, under the hood, on what it takes to qualify for some of these mortgages. So you can see the numbers, we can crunch them together, and you can see exactly what it takes to scale your portfolio. Click here to check it out.